high probability order blocks. As always, to support the channel, like this video, subscribe to the channel, and hit the bell notification to be notified every time we post a new video. Major news alert, guys. We have just launched, for a very limited amount of people, a signal room. We're going to be giving you the exact trades that our team is taking on a daily basis. This is not something that is going to stay around for long, and there are very, very limited spaces available. All info can be seen in the description of this video. Let's get into the video. How do we use order blocks? How do we identify order blocks? Now, for those of you who may be new to order blocks, let me show you what they are and how to use them. So you can see right here, we have this gray box marked out, and this gray box is essentially marked out because there lays an order block here. But what is an order block and how do we identify them? Well, order blocks, by the name of the word, are essentially areas of price where there are orders at that level. So what will happen is, just like any sort of block, when price gets there, it won't be able to move through it. So imagine price is trying to move through a wall, but there is a wall in the way. So price will not be able to move through it. That wall represents the orders from the banks and financial institutions. So what we can now identify is where the banks and financial institutions have their orders in the market. And that can be seen as a sell to buy or a buy to sell. So really the three steps that are needed for this are, there has to be a large level of momentum coming from the level. So what you can see is price comes down and then goes up drastically hard. Well, that momentum shows us there is a lot of buying power coming into the market at that given time, and it leaves behind something we call imbalance. Imbalance is simple. If you take the first wick, which is this gray wick right here, and then you take one candle gray, two candle green, three candles green, and take the wick of this candle, you will see that the wick of the gray candle and the wick of the green candle do not meet each other. So we have this space in the middle, and that space right there is called imbalance. So every time there is an order block, every time there is a level of imbalance, there will be an order block. And what has to happen with that order block and that imbalance is that price will have to come back to that area to fill it. So when price gets back in there, it's starting to fill it. So you can see price fills some of it here. So then the order block is like this. And then it comes and fills some of it here. And so the imbalance is like this. So we still have this level of imbalance right here in green. So that's a telltale sign that we have it. Again, if we just move Euro over and we go, candle 1 is the green one, candle 2 is the gray one, candle 3 is this gray one. So we go wick here, and then we go wick here of the green candle. What you can see is there is a gap in the middle, right? And this gap right here is what I'm referring to. This is imbalance. So for every high probability order block, there needs to be this level of imbalance. That is a sign that a lot of money has come into the market at that one given time. So you can then see how price comes back to fill this gap, and retrospectively it perfectly fills the orders because there are lots of sell orders in this candle right here, which I'm going to explain to you why that is in a moment. And then price starts to come down toward our other orders. So those are the two starting foundations, is the imbalance. Then after imbalance, there is purpose. Purpose is, what was the reason? What did it do? What did price do from that level? Why did they buy? So what we understand, if we just mark out the swings, you can see that the selling pressure came into the market. The selling pressure took out the lows. and then broke the highs inside of here, which is what? A change of character up. This was the shift from supply to demand. Supply coming down and demand taking control. So this is the area where the market first had its area of reversal. Funnily enough, so was this one, because what do you see? You see price coming down, high, low, high, low, high. Okay, so now we've had our shift, low, high, break, low, high, change of character. So that right there is the change of character to the downside, because it's a shift from demand to supply. Change of character down. And lo and behold, where did that come from? It came from here. So purpose is the second reason. The level has to do something. The level has to do something important. And then finally, you align this with a tool that we call premium and discount. So what we know is that price has an internal break of structure in here, break of structure up, and then it puts in a high. So if we take the low to the high, price needs to be in this, can be 50%, but ideally anything kind of like 75% and below is real premium. Discount, sorry. So we want to be buying in this bottom half and selling, of course, in this top half. And we want our level of orders to be in this level. So why does price respect these levels? Now, almost always what it is that price is going up before it comes down, or price is going down before it comes up. Because what the banks do is they like to buy before they sell, or sell before they buy, because this induces something called liquidity. So when we take out the lows down here, a lot of people, retail liquidity, lower banking liquidity, will be looking to sell the continuation breakout or whatever type of liquidity there is down here, and then go and hit the buy orders to the upside. The problem with this is that the banks, the algorithm that controls this market, the Federal Reserve, whatever you want to call them, they are the ones that initiated all of the sell orders inside of here. So whilst price is unmitigated, which is when price hasn't yet come back to the level, which price has not come back to this level yet, that is unmitigated. When price goes back to the level, it has mitigated. The difference is a mitigated zone can then start to move away, because when they buy to sell, their buys are running in a negative position when the price comes down. So think about it, right? If they buy to take out liquidity, to then sell, and that leaves behind this supply zone, all of these buys are running at a loss, and the further that the price comes down, the higher the loss of the buys. So they bring price back up, close the buys, and then bring price back down, and then up again, and then down again. It's a constant effect of opening positions and closing positions whenever they want to. So that is essentially that is what mitigation is. And so you can bet your money, which is what taking a trade is, on this level right here holding. And then if it gives the confirmation, and we know now that the confirmation is a change of character. So what happens is price comes into the level, taps in, pushes away, puts in a new low. So we have a break of structure to the downside, and then a change of character to the upside, because this is the high that put in the low. So that has now confirmed that this low is stronger than this high. The bank's orders to buy are stronger than the bank's desire to sell. Because if they wanted to take out of the orders, then this low would have been broken by this high. It's very easy. If this high fails to break this low, then this low is strong, which then means what? It will go and break the high. And that is confirmed through a change of character from our level of demand, which is our order block down here. When the change of character happens, then we know that we have a new order block. And our new order block essentially acts as a magnet to orders. It's going to attract the orders whenever price is ready to come inside and collect the orders. And then we know at this point, price has made equal lows also, or relatively equal lows at least. Maybe this is a tiny little bit lower, but we're still inside of the level of demand. Then into the 15-minute, we need to see a change of character again, because the change of character inside of here is going to further confirm our bias. So if you just look in here, guys, you can very clearly see that we have push down, push up, push down, push up, push down, push up, push down. So really, when you look at this, the last selling pressure comes here, right? This buy to sell. And when that gets taken out, that's our change of character, because it's the last point of supply gets broken. So that is our change of character to the upside. And that is how we confirm whether your order blocks are going to work or not. Many people will just put their money on order blocks and hope that they will work. But no, you must actually confirm them. And you confirm them with a change of character so that you can take a long position from this level right here. And you can zoom out and target your structural highs, because all we are actually trading is structure. All we're actually trading is structure, right? If you just zoom out right now, you will see that price actually gives an internal break structure here, mitigates the supply, comes back down to this order block that caused the change of character, changed character, come back down, and now it's going to go and take the highs. Take profit number one for us would be in this region right here. Again, just going to the 15-minute time frame so you can see this clearly. We're taking the order block. Why? Because there was a level of imbalance. Price mitigates, respects, takes out the high, and then continues. So that is how we confirm our order blocks, and that is exactly how it is that you use order blocks. If you want to learn to use order blocks like this, or if you just want to follow along on our team members' own trades, go ahead, hit the link in the description, and you will be diverted to a funnel that will give you access to those services. Thank you guys for watching, and I'll see you guys in the next one.